So, how does a massive, historically stable company sell $1 billion of premium pasta sauce in literally the exact same quarter that it loses 24% of its profit?
Right. Which sounds completely contradictory.
Totally. And the crazy part is they lost that profit because of like snowstorms and people just deciding to skip the snack aisle.
Yeah, it's wild when you look at the actual
It
numbers.
is. So today we are looking at a corporate landscape that is just transforming right under our noses, and we have the financial filings to prove it. So welcome to the deep dive.
Glad to be here.
We are taking a magnifying glass to the Q2 fiscal 2026 earnings presentation and the SEC Form 10-Q. And this was filed on March 11th, 2026 by a company you definitely have in your pantry right now.
Oh, absolutely. Everyone does.
But if you look at the very first visual in these sources, the branding has quietly but like very significantly changed. It doesn't say Campbell Soup anymore.
Right.
It prominently says the Campbell's Company.
Yeah, and that single visual pivot on page 1 of their earnings deck, I mean, it signals that this analysis is about much more than just what you heat up on a cold day.
Exact.
It is a fundamental repositioning of their entire corporate identity.
And for you listening, whether you are prepping for a major investment meeting or tracking consumer goods, or honestly, if you're just insanely curious about what's dictating the grocery store aisles, right now, our mission today is to decode the shifting dynamics of the modern pantry.
Which are shifting incredibly fast.
So fast. We're going to uncover how severe weather events, changing consumer habits, and a super dynamic operating environment are impacting what you eat, and how this legacy company is pivoting to keep up with you. So, okay, let's unpack this.
Well, I think we need to start with the raw Q2 financials because the top line reality check here is undeniably stark.
Yeah, it's not a pretty picture initially.
Not at all. I mean, management themselves admitted the overall performance was just below their expectations. Total Q2 net sales dropped 5%.
Wow, 5%.
Yeah, landing at roughly $2.56 billion.
Right, though I did notice the presentation quickly tries to pivot the focus to organic net sales, which were still down 3%.
Yeah, they always try to highlight the organic numbers.
Sure. And for those analyzing the raw data, the difference between that 5% drop and the 3% drop is just like corporate noise, stripping out the impact of foreign exchange rates or recent brand acquisitions.
Exactly, gives us a cleaner look at the base business.
Right, but honestly, the top line revenue isn't even the number that jumps off the page for me. It's the profit.
Oh, the profit hit is massive.
Yeah, adjusted EBIT took a significant 24% hit compared to the prior year, and adjusted EPS landed at 51 cents. So I'm looking at this 24% EBIT drop, and then I read management's explanation, which blames basically two things.
Right, the snacks and the weather.
Yeah, a delayed recovery in their snacks division, and surprising storm-related shipment delays that impacted the meals and beverages results.
And, the weather element is fascinating from a supply chain perspective.
How so?
Well, we tend to view massive food conglomerates as these, unstoppable logistics machines. But they are incredibly vulnerable to macro disruptions. Severe winter storms temporarily froze their ability to move physical product to retailers.
But help me out here, because this is the puzzle I keep coming back to. Campbell's products are largely non-perishable.
Right, they sit on shelves for months.
Yeah, a can of soup or a bag of pretzels does not spoil if a truck is stuck in a snowbank for 3 days. So if the product eventually gets to the store, why does a temporary weather delay cause a quarter-ruining 24% profit drop? Like, the demand didn't vanish, right?
No, the demand didn't vanish at all, it just shifted.
Mhm.
But you are hitting on the critical mechanics of quarterly revenue recognition.
Okay.
And really the reality of retail inventory management. Yes, the soup doesn't spoil, but grocery retailers today, they operate on incredibly tight, just-in-time inventory model.
Oh, right, because they don't want to pay for storage.
Exactly.
Yeah.
They don't have massive back rooms holding weeks of surplus product anymore. So if a shipment doesn't arrive by a specific date, the retailer's shelves go empty.
Which means consumers can't buy it.
Right, and the manufacturer misses the fiscal cutoff for that quarter's earnings. Even if that exact same truck unloads its product on day 1 of Q3, the Q2 ledger still takes the catastrophic hit.
That's crazy. It's basically an optical illusion created by the calendar.
Completely. The manufacturer eats the immediate financial loss while the physical goods just sit idle on a highway somewhere.
Which honestly introduces this incredible contradiction when we look at the consumer side of the equation. I've been calling this the seesaw pantry.
Oh, I like that, the seesaw pantry.
Yeah, because we have literal storms stopping trucks from getting meals to the retail stores, a massive logistics failure on one side of the seesaw.
Okay.
But while those trucks are stuck, the actual consumption of the meals already sitting in consumers' pantries at home tells a totally different story.
Right, because people are stuck at home too.
Exactly. The storms stopped the delivery, but they actually forced families to stay inside and eat the inventory they bought last month.
And that distinction between factory shipments and in-market consumption is really the key to understanding this entire 10Q filing.
It really is.
The shipment delays impact the manufacturer's top line immediately, but the consumer at home is completely insulated from that specific supply chain hiccup. They are still opening their cupboards.
And that data is the bright spot in their meals and beverages division. The sources show that organic net sales for M&D dropped 2%, reflecting those delayed trucks.
Right.
But if you look at the in-market dollar consumption, like what people are actually scanning at the cash register and cooking in their kitchens, it actually grew by 2%.
The shipments went down, but the eating went up.
Exactly. The filing explicitly cites, quote, cooking at home tailwinds as a major anchor for the entire brand portfolio. People are aggressively returning to the kitchen.
What's fascinating here is how that 2% consumption growth proves the resilience of this behavioral trend.
Yeah, it's not just a pandemic fad anymore.
Not at all. I mean, a logistics issue is a temporary blip. You clear the roads, the trucks move again. But a rising consumption trend indicates that despite inflation and despite, a massive push to return to the office, the modern consumer is stubbornly holding on to the habit of making meals at home.
They just aren't reverting to pre-pandemic dining out frequencies.
No, they aren't.
Well, let's look at the specific soup statistics because they illustrate this shift perfectly. Overall, Campbell's wet soup dollar consumption grew a modest 0.2%.
So basically holding steady.
Yeah,
Like-
flat. But condensed soup specifically, that saw a 2.9% jump in consumption.
Which is a huge difference.
It is. To me, that indicates people aren't just, like, heating up a bowl of tomato soup for a quick lunch. They're using condensed soup as a functional tool to cook complex dinners.
Well, condensed soup is historically the ultimate utility ingredient, right?
Oh, for sure. Cream of mushroom goes in everything.
Exactly. It's the structural base for casseroles, slow cooker meals, large family dinners. That 2.9% jump is a direct reflection of households trying to stretch their grocery budgets.
They're scratch cooking larger multi-serving meals.
Yeah, it's pure economics.
But the absolute crowning achievement in this whole portfolio, the data point that really just blew my mind in these sources, is Rouse.
Oh, the Rouse numbers are incredible.
The filings reveal that the total Rouse brand has officially surpassed $1 billion in net sales over the trailing 12 months. $1 billion for pasta sauce.
It is a staggering milestone for a single brand within a broader portfolio.
I can't even picture $1 billion of marinara.
It's a lot of jars. But if we analyze why Rouse has achieved that level of market dominance, it speaks directly to the evolution of the home cook's economic calculus.
Right, because Rouse is positioned as a premium product.
Highly premium. It has a significantly higher price point than a standard jar of generic marinara. It essentially promises a restaurant-quality experience straight from the grocery store aisle.
And buyers are absolutely willing to invest in that high-quality at-home meal even when budgets are tight.
That's the paradox. Right?
Yeah. They might look at their bank account and decide, okay, we aren't going out to an expensive Italian restaurant this month, but they will gladly pay $8 or $9 at the grocery store to elevate their Tuesday night dinner.
It's premiumization as a budgeting strategy.
Exactly.
It is the save-by-spending mentality. You spend double on the premium sauce to save $80 on the restaurant tab.
Which makes perfect sense when you frame it like that.
It does, but this dynamic introduces a massive strategic dilemma for the Campbell's company.
Because they have two very different types of consumers right now.
Right. You have consumers who clearly want to cook at home, as evidenced by the condensed soup jump, and you have consumers willing to pay for premium convenience, as evidenced by the billion-dollar Rouse milestone.
But both of these consumers are simultaneously time poor.
Yes, they are exhausted.
They want the result and the emotional satisfaction of a home-cooked meal without the 2 hours of chopping, simmering, and cleaning up.
They want the absolute middle ground.
So if you're Campbell's, how do you capture that exact middle ground?
Well, you look at their newest product launch, detailed in the earnings presentation, the new Campbell's condensed sauces.
Yes, the presentation showcases these new cans, and they look incredibly similar to the classic soup cans we all know, but they are branded very specifically as sauce.
The branding is highly intentional there.
Oh, definitely. And the flavor profiles they list are like creamy lemon garlic, butter chicken, smothered chicken with Creole seasonings, and Thai curry.
Right, much more complex than just chicken noodle.
Exactly. And the pitch they're making to the consumer is hyper specific. 3 ingredients, 2 steps. You just cook your favorite protein, add the sauce and some water.
And it serves 4 people in 20 minutes or less.
Notice how meticulously designed that pitch is.
They are engineering friction completely out of the cooking process.
But I have to push back on this so-called innovation, honestly.
Okay, why?
I am looking at these cans, I'm looking at the nutritional profiles and the history of the company. Wait a minute. Isn't this just condensed soup with a different label?
You're not entirely wrong to ask that.
I mean, my grandmother used condensed cream of mushroom to make chicken bakes for 40 years. Are they actually innovating a new product category, or is this just clever marketing to dress up the same old liquid and charge a premium for it?
That skepticism is entirely warranted, especially when you look at the manufacturing process. They likely utilize the exact same production lines as their legacy soups.
Right.
But if you look at the underlying consumer psychology and the business strategy outlined here, it is a highly calculated evolution. They are no longer selling a liquid ingredient.
So what are they selling?
They are selling a defined meal solution.
Ah, I see. They are monetizing a shortcut.
Precisely. By explicitly labeling it a sauce and putting a rigid 20-minute two-step recipe right on the front of the can, they are targeting a completely different cognitive mindset.
They are going after the demographic that desperately wants to cook dinner but maybe lacks the culinary confidence.
Or just the time for scratch cooking. By providing complex flavor profiles like the Thai curry or Creole smothered chicken, they're offering something that would normally require buying 15 different spices.
And they are making it completely foolproof. They reduce the cognitive load of meal planning to 0.
Exactly. And the financial target they've attached to this pivot is massive. The presentation states this new product line is designed to unlock a $1 billion at-home cooking addressable market.
Wow. So they see the billion-dollar success of Rouse. They see the utility jump in condensed soup, and they are just trying to engineer a product that sits precisely at the intersection of both trends.
They're trying to build a second billion-dollar empire out of pure convenience.
But we cannot ignore the other side of the ledger here. For all the success they're finding in capturing the at-home dinner crowd, there is a severe drag on their overall earnings.
Yes, we have to talk about the snacks.
The snacks division is bleeding.
It really is.
And this is where that 24% profit drop really starts to make sense, beyond just the stuck trucks. The data shows a 3% drop in dollar consumption for snacks.
And a loss of 0.3 points of market share.
Which, to an outsider, 0.3 points might sound like a rounding error, but in the consumer packaged goods space...
Oh, losing a third of a point of market share is a 5-alarm fire.
Especially when you contextualize it against the sheer scale of their snack portfolio. We are talking about foundational brands here.
Huge brands. Goldfish, Pepperidge Farm, Snyder's of Hanover.
Cape Cod potato chips, Lance crackers, Snack Factory, pretzel crisps. These are items that have literally dominated lunchboxes for decades.
So why the sudden drop? We just established that people are eating at home more than ever.
Right.
Why would they buy more soup and pasta sauce but suddenly stop buying pretzels and goldfish?
It has to come back to that economic prioritization we discussed earlier, right?
Exactly. When grocery budgets are under immense inflationary pressure, every single item in the cart gets scrutinized.
Right. A premium meal solution like Rouse is justified because it serves a core utility. It feeds the family dinner and replaces a $50 takeout order.
But a bag of Cape Cod chips, that is a purely discretionary purchase.
It doesn't replace a meal, it's just an additive cost.
Exactly. When a consumer needs to keep their total grocery bill under a certain threshold, the discretionary snacks are just the easiest things to leave on the shelf. The perceived value of the meal is currently far outpacing the perceived value of the snack.
That makes total sense. The 20-minute dinner stays in the cart because it solves a very real problem. The crackers get cut because they are just an extra expense.
Yep.
So because of this delayed recovery in snacks, management actually had to update their full fiscal year 2026 guidance. They had to temper expectations for the rest of the year.
They did.
But a company this size doesn't just accept a loss in market share. What is their strategic fix here?
Well, if we connect this to the bigger picture, The financials show they are taking immediate aggressive action on the operations side. They absorbed $24 million in costs associated with savings and optimization initiatives just in the second quarter.
24 million just to optimize.
Right. They are streamlining their manufacturing, consolidating supply chains, and reducing overhead to aggressively enhance their margins.
So they are spending millions to find operational efficiencies, but what do they actually do with those savings once they find them?
Well, the filing says they are funding, quote, slight incremental trade investments.
Okay, stop right there. Translate that from corporate speak for us, because trade investments sounds like they are, buying stocks or something.
Yeah, that's not what this means in the grocery world at all.
Right.
In the consumer packaged goods industry, trade investments is basically the polite term for the literal real estate war happening inside your local grocery store.
Oh, interesting.
Manufacturers don't just put their products on a shelf for free. They pay the retailers for visibility and positioning.
So we are talking about slotting fees, temporary price reductions, those massive cardboard end cap displays at the end of the aisle.
Exactly that. When Campbell's loses 0.3 points of market share in snacks, they have to buy it back.
Literally buy it back.
Literally. They take the money saved from those operational efficiencies and use it to fund promotions. They negotiate with the retailer to run a buy one, get one free deal on Snyder's pretzels.
Or they pay a huge premium to secure that highly visible display space right at the front of the store so you see goldfish the second you walk in.
Exactly. They are effectively subsidizing the cost of the product at the retail level to force their way back into the consumer's shopping cart.
Wow.
It's this highly expensive, margin-crushing necessity to stop the market share bleed.
So we were watching them play a fascinating dual strategy. They are playing offense in the meals and beverages division by launching new premium sauces to capture the busy home cook.
Right.
And they are playing desperate defense in the snacks division by throwing operational savings into a promotional war just to hold their ground.
It is a masterclass in how a dynamic operating environment forces rapid, multi-front adaptation. You really just cannot rely on legacy brand awareness alone anymore.
So let's take a step back and sort of recap the landscape we've mapped out today. We started with a shocking Q2 earnings miss, driven by a struggling snack aisle and trucks literally frozen on the highways.
Which really exposed the fragile nature of just-in-time retail inventory.
It totally did. But underneath that top-line drop, we found a consumer base that is fiercely protecting their habit of cooking at home. We saw a single pasta sauce brand, Rouse, build a $1 billion empire by offering premiumization as a budgeting tool.
And we watched a historic company pivot its iconic soup cans into 20-minute meal shortcuts.
Right, to capture a massive new market of time-poor cooks, all while tightening their corporate belts just to afford the exorbitant slotting fees required to keep their snacks relevant.
The entire ecosystem of the grocery store is just in a state of flux, driven entirely by the shifting economic calculus of the end consumer.
And it really makes you think about your own grocery habits. For everyone listening, next time you are pushing that cart down the aisle, really analyze what you are actually putting in it.
Absolutely.
Are you reaching for those premium two-step sauces to avoid ordering takeout? Are you actively skipping the snack aisle to keep the final bill under control? Or are you buying the buy one, get one free pretzels without realizing you are the target of a targeted trade investment strategy?
Because you are part of the exact data set we just analyzed.
You really are.
And if we look past this current quarter, there is a profound long-term strategic risk hidden in this data.
What's that?
By aggressively pushing consumers toward these premium $4 or $5 meal solution sauces, the company is successfully increasing their revenue per unit. But they are also training their core demographic to abandon the $1.50 can of basic condensed soup.
Oh, wow. Wait, so they risk cannibalizing their own foundational business.
Precisely. If a consumer gets used to the convenience of the pre-flavored butter chicken sauce, they might never go back to buying the plain cream of chicken soup to make a recipe from scratch.
That makes total sense.
And, more importantly, by vacating that budget-friendly price point to chase the premium dollar, they leave the door wide open for grocery store, private labels, store brands to swoop in and dominate the traditional soup market.
Wow.
They might win the billion-dollar sauce war, but completely lose their historic monopoly on the soup aisle in the process. Which begs the question, as companies blur the lines between a shortcut and scratch cooking, Well, the very definition of a home-cooked meal fundamentally changed for the next generation.
That is a brilliant point and definitely a thought to chew on next time you grab a jar of that billion-dollar marinara or walk past an empty end cap of pretzels. I want to thank you for joining us on this exploration of the Campbell's Company's Q2 reality. Until next time, keep your eyes open in those grocery aisles. Remember, the economic forces shaping the modern pantry might seem invisible, but the insights are always hiding right there on the shelf.